By land agent.
Real estate is the oldest, most established asset class, and like stocks and bonds, it cannot go to zero.
Because God ain't making any more of it.
We have the opportunity to get these assets managed by firms that have built a reputation for not losing money.
It's very, very difficult to get any investment proposal approved at our firm. And the reason is we have a motto here, don't lose money.
When real estate investments are managed by a firm, it's called private real estate investing. And that creates an irresistible investment opportunity. And things are changing.
I've always wondered, why weren't individuals doing the same things as the big institutions? And it was only relatively recently where private investors started buying these types of securities that we create.
New types of firms promise access to this private real estate investing and all their benefits, like Yieldstreet. In fact, its motto used to be invest like the 1%. Now it has rebranded to Willow Wealth, which is a bit weird in this industry because normally it's about legacy, track record, continuity, etc. We'll leave this for another time. As you guess from the old name, it specializes in yield. And yield is a safer part of the investment universe. There's the stock market where there's unlimited upside, but you can lose your capital. When we talk about yield, we talk about income on a regular basis with limited upside, also expected limited downside. If we look more closely at the product range, we see what we expect: yield products in partnership with important private asset firms in different asset classes. And currently there's only one real estate opportunity, whereas that's what Yieldstreet was known for. And when you look at the past private real estate deals of Yieldstreet, this is when something unexpected happens. Out of 30 deals, 4 have been declared total losses, and many of the rest are in danger. It looks like investors will lose some of their capital.
Yieldstreet is probably the best known of this wave of startups that promised the retail investor access to these esoteric assets like real estate, litigation proceeds, things like that, private equity, private credit. And what I found digging into their actual results, Frank, is that you mentioned these 30 deals, and so 23 of them have already gone to watch list, which is essentially saying they could default. 4 have actually defaulted. And what that means, Frank, is that investors have plowed $370 million into these funds, and $78 million have already defaulted.
So this is a puzzle. How can you lose all your money by investing in real estate? Those houses are not disappearing. And what happened to this additional protection level of having a safe asset class such as real estate managed by a safe pair of hands? And that's the case of private real estate. This is the puzzle that we're going to solve now. And it's going to bring us to some very obscure but important areas of finance. To do that, we have to look into the products. Unfortunately, there's not many real estate deals, but based on my research, this aviation product is actually very similar to the previous real estate deals. If you look at it on the surface, it's about financing a business that will buy and lease planes and then potentially sell them. So it's actually not that different from a real estate deal where you buy properties and then maybe sell them on. And on the website, we see a lot of elements of the deal. We understand what it's about. We see that it's a quality portfolio, that there's potential for downside protection, and there's a rationale behind this. There's demand for airplanes and stuff like that. But what I want to look at is a critical word in this yield product that is mentioned once. Yieldstreet is participating in the equity position of a joint venture with Creston Partners, an affiliate of Blue Owl, which are both like private asset firms. Equity and joint venture are important information. If we look at equity first, we understand that it's not equity in the sense of the stocks and shares that we know. It's the name for the structure of the deal. So there's typically different types of tranches, which are classified into senior, mezzanine, and junior. And then there's junior equity, which is what we're talking about here, which is the most risky and the most potential upside. And this equity part is typically purchased by investors who are very specialized, such as hedge funds, credit funds, and also are owned by the manager itself. Those people will actively manage the position.
Location's the key, right? I mean, otherwise you get stuck with shit.
Sometimes there's money and shit.
How do you mean?
So we're looking for a joint venture, which means some kind of equal agreement with people like that. To understand better, we need to look at the prospectus, which is a 96-page document, quite a dense one. And we understand here that the participants are Yieldstreet on one hand, and then the managers on the other hand. And there's no intermediate tranche, it's just senior and equity. So we're in the equity tranche. One way to understand the structure and the risk is to see it from the point of view of the other party, the ones that hold the senior loan. So it's important to consider the whole economics of the operation, so the yield, as well as the value of the planes when they're sold. We take all that into consideration, and it's first going to be used to pay back the senior loan. To be specific, because the equity tranche is 49%, and because the total value of the deal is 100 million, if air travel somehow crashes, there's no yield, we cannot lease out those planes anymore, and also the resale value is cut by half. That's the threshold where the senior loan will still get its coupons and capital back. What that means for the Yieldstreet investor is that they will absorb any losses. I've got a table here that shows roughly how this works, and it's assuming that the lease of the plane goes exactly as planned, and we simply isolate the value of the aircraft. If this value drops by more than 6%, then we start losing capital. And if the value dropped by 50%, we've lost all the capital, and then it's gradual, 20%, 30%, you get 60 or 40% of your capital. There's a lot in this 96-page document, but I want to just focus on two other elements. One is the expenses. One is the control. And remember, it was described as a joint venture, but if you read carefully, all prospective investors should understand that investors will have absolutely no direct interest control, voting right, or involvement in the business. There's a lot more there that explains that it's the manager that will have absolute ownership and control of what happens to the company, to the planes, and everything else, including what happens in case things go wrong. The second element is the expenses of the company. So whatever expense the manager has is also more senior than what the equity tranche will get. And those expenses are very detailed in a very long paragraph and is repeated many times over the document. In essence, there's no limit to what expenses they can do. And that includes, for example, if things go wrong, you need to get lawyers involved. This will come out of the liquidity of the company. And if you need to inspect a plane, if you have a research analyst working on this, you can assign how much of their salary is an expense that is on the company. We talk about a joint venture. Clearly, one side of the contract has total operational control and also financial control. And that explains how the real estate deals could result in a total loss. We know it was an equity deal. Therefore, if the property prices diminish, if the rent as well diminish, this is all impacted straight away to the equity holders, while the senior holders get paid full, and any expenses, such as getting a lawyer involved to get the rent, will be covered as well in this liquidity waterfall.
I want what I am entitled to.
You're entitled to
So that's how the money can be lost, but it gets even weirder. If we look at the press release from the company after it announces that people will not get any of their capital, it says, given the continued dynamics, etc., we determined that additional capital infusions would not likely change this outcome. Therefore, a sale was the most prudent option on behalf of investors. Yieldstreet and the sponsor engaged a national recognized brokerage firm to facilitate the sale process. The property received significant interest from institutional buyers with 18 formal offers. Ultimately, we decided to move forward with a bid from Tishman's Payer that provides us with the highest proceeds. So, even if the investors in Yieldstreet go to zero, this is called the best outcome, the most prudent outcome. And those properties are still standing and they look pretty nice. Although there may be one property, there are many types of investors and many types of outcomes. Welcome to the covenant structure of yield in private credit. This is based on a recent research, which explains very well what is happening. In private credit, liquidity is not discovered through market making, but deliberately engineered through contractual design. In other words, the outcome is not about how the asset performed, it's about how the contract is written. And there is a contractual liquidity hierarchy, multiple structure of exit engineering, optionality structuring, and cash flow pacing. It also talks about the alpha, which is kind of the added value of the manager. And the alpha is contractual, and it's embedded ex ante through legal design rather than inferred from traded prices. So picking the right asset is only one part of the deal. And there's always the case where everything goes well and everyone will be happy. But in all the other cases, the alpha is in the structure. It allows, in particular, to allocate the losses. And what it means in terms of investing like the 1% is that you can invest in the same asset class, the same buildings, but you will not be getting the same results because you're not the same contractual liquidity hierarchy. Now that we've understood how you can manage to lose all your money on real estate, I want to explore further this mystery of Yieldstreet. Yieldstreet is a firm that bucks the trend across all private asset firms, which are built on legacy, on track record. Yieldstreet has managed to have terrible performance, but at the same time raise significant amounts for the future of the company. And this is what we're going to explore in the next video. Thanks very much for watching. If you're interested in that, I think you'll also be interested in the marketing of private equity in the video link below. Thank you.